Hi, I'm Damona Doy, Extension Economist at Oklahoma State University. In this segment, I want to discuss developing equitable lease agreements. I'm going to begin by emphasizing that when people call or email wanting to know what's the right rental rate for a piece of property, I always stress that there's no one size that fits all. Every property has different attributes, whether it's soil type, slope, fencing, water, and so on. The good news is that in our biennial lease surveys, more than a half of survey respondents classify agreements as good or excellent. Still, there may be room for improvement. If you are new to agriculture, understanding best practices provides a good foundation for negotiations. I'll also provide some data on average rental rates and traditions for share rental agreements in Oklahoma. I'll focus mostly on pasture and crops, but the principles are the same for livestock. Leasing is an important means of controlling the land asset for farming and ranching nationally. This is especially true for beginning operators, as rental payments are significantly lower than principal and interest payments on a land note. On average, almost 40% of farmland is rented. The darker shading of this graph shows counties where 50% or more of the land is rented. In Oklahoma, the highest percentages are in north-central Oklahoma in our most productive wheat areas. This chart shows historical rental rates and land values for Oklahoma. Land values are shown with the blue line with the scale at the left. Average cropland values have increased from $200 per acre in 1970 to more than $1,600 in 2016. Values rose quickly in the 1970s before declining significantly during what's referred to as the farm crisis. Cash rents, shown with the red line, also increased dramatically in the 1970s, but have trended up only modestly since the mid-1990s. Average cropland cash rents dipped back down to $30 per acre in 2016, based on USDA National Ag Statistics Survey data. The chart for pasture cash rents and land prices has a pattern like that of cropland. Pasture land values, shown by the red line, didn't increase as dramatically in the 1970s, but have increased significantly since 2006, now averaging almost $1,400 per acre. Average pasture land values have increased from less than $200 per acre in 1970 to more than $1,400 in 2016. Cash rents, shown with the blue line, increased dramatically in the 1970s, then declined, and have trended up since the mid-1990s in Oklahoma. The rate of increase in rents has been slower than the rate of increase in land prices. Unlike cropland cash rents, however, pasture rents have continued to increase. In thinking about terms for a rental agreement, these 5 questions need to be asked and answered. First, what portion of the income do I receive? For example, if it's land that includes wheat, are you sharing the grain crop, grazing income, baled straw, hunting income? Next, what portion of crops of the cost will I pay? With a cash lease, it may be none. But if it's a share lease, will we share feed, fertilizer, fencing, harvest costs, and what amounts? It may be different for different items. What portion of the risk do I bear? Risks may be production, marketing, financial, legal, or human in nature. What crop and land management practices will be followed? No-till or conventional tillage? Cover crop or no cover crop? What will be the condition of the land and improvements at the end of the lease? Will soil tests be required? Do we have to agree that fencing has been maintained? Either cash or share lease agreements may be single or multiple years. In Oklahoma, most leases are annual but have been in place decades. Multi-year leases provide some security for tenants in that they can plan to make investments with more confidence. To reiterate, income, cost, risk, management practices, and condition of the assets are all items to be weighed. With a cash lease, the tenant is leasing the land and crop base. The tenant bears all price and production risk and reaps the benefits of managerial expertise and risk-taking. Because of that, all government payments go to the tenant. To build in some risk sharing, a flexible component can be added to the cash lease, either through price or yield adjustments. An example of flexible component would be to multiply base rent by the ratio of current year's actual harvest price to an established base price, which could be a futures price at a specified time or the state average price reported by USDA. You can also index the yield. In this case, you might specify a base rate that's equal to a multi-year historical average based on records, with an adjustment for the actual yield. If the yield is below average because of drought, for instance, the rental rate might be adjusted down with the landlord receiving less. It's important to determine in advance the information sources to be used. For example, Oklahoma Ag Statistics, which may result in a lag of a year to get to the end of a harvest year, or local posted prices. Price or yield risk adjustments provide a way to share risk without creating a record-keeping burden or requiring the landlord to come up with cash for inputs. Cash leases may be a low-stress option for the landlord as they provide the land and step away from management decision-making entirely. They don't have to come up with cash for fertilizer or provide labor. They don't have to negotiate about when and where to sell crops. Landlords can have confidence in both the amount and timing of the rental payments. Payments can be scheduled to coincide with harvest, be split up with some or all of the payment up front, or any other number of combinations. Tenants typically appreciate having part of the lease payment scheduled for harvest. With a cash lease, the tenant has the maximum and personal incentives to get things done in a timely fashion, plus see that the crop succeeds as they're bearing all the risk. They make decisions and receive the benefits or bear the cost of their choices, and there are fewer communication, record-keeping tasks for them in cash as compared to share leases. Share lease agreements are ones in which the parties share proportionally in cost, risk, and income. Because of risk sharing, government payments are also shared. The challenge in developing equitable share lease agreements is in valuing the different contributions and ensuring that the incentives are aligned to maximize returns to all parties, while also protecting the short and long-term interests of the parties, for instance in maintaining conservation practices. The advantages of share leases are mirror images of cash leases. Here the landlord also reaps some of the benefits of better than average years. If wheat goes to $6 when it was budgeted at $3.50, the share lease means they also share in the windfall. Because they're still involved in management decision making, land and improvements may be more likely to be maintained to their satisfaction, but they don't have to do everything. From the landlord's perspective, doing less than if you're farming yourself can be a good or a bad thing. The right tenant helps make it a good thing. For tax purposes, it's possible to establish that the landlord has materially participated when it's a share lease. From the tenant's perspective, they don't have to come up with as much cash for farm expenses as the landlord's also contributing. For beginning farmers, having an experienced landlord involved can provide beneficial learning opportunities. The tenant doesn't bear all the price and yield risk, so may be less vulnerable to failure and better positioned to build equity over time, even if it's slow. Each of the advantages noted here is linked to a disadvantage as well. For instance, sharing in decision making requires more communication and means more opportunities for disagreement. The trade-offs in cash versus share lease need to be carefully weighed and reevaluated periodically as circumstances change. Often I'm asked about the fairness of a rental rate or provision in a lease agreement. Fairness, like beauty, is often in the eye of the beholder, but clearly not fair would include not compensating a tenant for improvements that will stay with the land when a lease is terminated, for instance lime or fencing or buildings, mining the soil as a tenant, or raising the rent because a new tenant's doing a better job of managing and has higher yields. That said, let's be clear. Fair does not equal legal. Legal does not equal fair. And everything is negotiable up front. Legal is what you agreed to, or if it wasn't discussed in the agreement, it will be what the law substitutes. So think about as many different angles and potential problems as possible in formulating your agreement. Of course, the golden rule may be helpful as well in resolving disagreements. That is, do unto others as you'd have them do unto you. Finally, economists would argue that the approach should be to come up with a plan that is equitable, which puts the emphasis on properly valuing the different contributions. Let's start with identifying an equitable cash rent. 3 approaches are recommended. They may yield different values, but that's the point. We want all parties to make an informed decision. The first approach provides insights into what the landlord might want based on a return to equity and cash cost. The second approach is similar to that for land appraisal and using budgeting to look at potential returns and ability to pay. The third is focused on market evidence of what might be labeled the going rate in an area. What's comparable land renting for? All of these different approaches yield what can be argued are reasonable values. The challenge is then to negotiate a final rate. Again, there is no one size that fits all. In the approach focused on the landlord's ownership costs plus return to equity, we estimate property taxes and any other ownership costs such as maintenance of improvements, insurance, and depreciation. We add to that an estimate of the desired return on the investment. What's the right rate to use? Probably something less than the stock market, but perhaps more than a CD. It's generally unrealistic to expect a 9% return on ag land in Oklahoma. In this case, we've used 3% and the average value for cropland of $1,600, which yields a $48 return on equity. Adding a couple of dollars for property taxes would suggest a $50 per acre rent. Note we used ag valuation for the land, not its potential for development or other uses. The residual income process essentially requires developing a budget that itemizes the expected returns and the costs contributed by the two parties. The variable costs are those that change with the level of production, while fixed costs will be incurred whether or not production is started or bears fruit. Variable costs include inputs such as seed, fertilizer, and chemicals. Examples of fixed costs include insurance and taxes, plus ownership costs such as depreciation on machinery and equipment, and the opportunity cost on money tied up in assets such as land. Variable costs are typically transparent, though a value may need to be placed on operator labor that is contributed. The contributions of land, machinery, and equipment, labor, and management may be more challenging to value, but certainly must be recognized. One option for valuing machinery and equipment contributions is to have the owner prorate annual cost to the lease based on the portion of the total acres operated. For instance, if the total machinery, depreciation, insurance, taxes, and interest on the average investment is $50,000 for an operator, and the lease represents 10% of the acres farmed, $5,000 would be included as the operator's contribution to machinery and equipment. But if it's difficult to calculate those fixed costs to machinery and equipment, you could use the custom rate for the field operations, spraying, and so on as a proxy. The management fee may be a fixed amount, or it may be specified as a percent of average capital investment or gross receipts. A common range for a management fee based on gross farm receipts is 5 to 8%. When estimating the opportunity cost on the funds invested in agricultural assets, consider what those funds could earn in a similarly risky investment. One option is to use the interest rate on certificates of deposit, add a risk premium appropriate for the agricultural enterprise, and subtract the expected appreciation in land value. So if CD rates are 0.5%, the risk premium is 3%, and the land is expected to appreciate 2%, the opportunity cost interest rate would be 1/2 plus 3 minus 2, or 1.5%. Another alternative is to use what's labeled the capitalization rate, which is calculated by dividing the annual cash rent by the per acre land value. If cash rents for comparable land are $30 per acre and the land is valued at $1,500 per acre, the capitalization rate would be 2%. When valuing the contribution of land, differences in quality of land must be factored in. Good, rich, loam soil that doesn't flood contributes much more to potential profits than sandy soil that blows. The graph illustrates this point. Cost of putting in a crop are essentially the same regardless of the quality of land. Hence the flat red line. Better soils in higher rainfall areas have much greater yield potential, so are much greater possible gross revenues. So landowners with high quality land may reasonably expect a greater percentage of the crop, or may want to contribute less to variable cost. The OSU Agricultural Budget website has a variety of templates for major commodities that may be useful to you in this process. The numbers can be customized to match your farm situation. If your records show higher average yields, or you are able to rent out pasture for more, make the necessary adjustments. In this example, you can see the returns above variable costs are projected to be negative without a charge for land due to very low anticipated market prices and no adjustment down in inputs and costs from the typical year. This would suggest that no payment could be made for rent to the landlord, which of course isn't realistic. If this were irrigated cropland, it would be important to also value the fixed contributions of irrigation equipment. The OSU budget tools highlight break-even prices and yields at the bottom, which may be helpful in managing as well. Market value data may be available anecdotally locally, but you'll also want to consider public sources as well. The School Land Commission's annual auctions are one source. USDA's National Ag Statistics Service conducts a biennial survey on cash rent that yields a county-level value for pasture and cropland. Note that the value for pasture doesn't distinguish between introduced or native pasture. These charts highlight the variability in cash rental rates across the state as reported by NASS. In the chart at top left for non-irrigated cash rents, you can see that the highest rents for cropland are in the most productive cropland in north central Oklahoma, plus more urban areas along I-40. In contrast, the chart at bottom right shows pasture rents are highest in northeastern Oklahoma. OSU collaborates with NASS in alternate years on a rental rate survey to provide some different insights. However, because the number of survey responses is much fewer, only regional differences can be reported. Results for 4 regions will be highlighted: Eastern Oklahoma, which is basically east of I-35, North Central, Northwest, and Southwest. Here are the results from the current publication, OSU Current Report 230. The numbers on the top line in each row show the average. The state average for cropland and wheat was $35.54 per acre, and for alfalfa was $54.85, a bit more of a spread than usual. It's usually about $15. The rental rate for cropland in grain sorghum is typically similar to that of wheat pasture. The average is typically highest in north central Oklahoma. The numbers below the average show the range of responses. For example, while the average cropland rental rate for north central Oklahoma is $40 per acre, the survey responses ranged from $18 to $60 per acre. This emphasizes that the average provides a piece of information, but it may not necessarily be the right rate for your land, as is evidenced by the many other different responses. Current Report 216 reports pasture rates. The state average for native pasture was $13.39 per acre, with the highest rates again in north central Oklahoma and lowest in northwest Oklahoma, where lower rainfall limits the stocking rates. Bermuda pasture rental rates averaged $21 per acre, but with a range of reported values from $8 to $81 per acre. Other pasture is primarily Old World Bluestem in western Oklahoma and fescue in eastern Oklahoma, and commands a higher rental rates than native pasture. I would note that though rental rates have historically been slow to change, we'll be updating this publication in spring 2017, so you'll want to check back to those 2 current reports for updated numbers. So in this example, our application of 3 different methods for deriving an equitable cash rent have yielded a wide range of values from $0 to $50. These numbers provide the basis for negotiation. The challenge, again, is to identify the characteristics of this parcel and what makes it different, if any, from other comparable land. Let's shift now to discussing the process for developing an equitable share rent arrangement. The bottom line, of course, is that the share of the return should match the share of total variable and fixed expenses, where variable costs are things like seed, fertilizer, and fuel, and fixed costs are insurance, taxes, and depreciation on machinery and equipment, and more. Labor and management must also be valued. A key point with variable expenses is that you want to have incentives aligned with profitability. It's a good idea to share fertilizer expenses, for instance, as fertilizer is yield enhancing. You don't want high fertilizer prices to result in skimping on needed plant nutrients, as that might limit yield, resulting in revenue losses that are greater than the cost saved by skimping on fertilizer. Typically, the tenant is providing the machinery and equipment, labor, and management. While I briefly described approaches to valuing these contributions earlier, you'll find more detail in reference publications associated with this segment. Another important point is that as technology changes, lease parameters may need to be adjusted. For instance, a shift to no-till may increase variable costs such as chemicals and application costs and reduce the labor requirements. The resulting trade-offs may mean share percentages need to be adjusted. Finally, it's important to have provisions in the lease that would compensate the tenant for any improvement that would remain with the land when the lease ends or is terminated. For instance, if a tenant puts down lime that's expected to yield crop benefits for 5 years and the landlord opts to not renew the lease at the end of 3 years, the tenant should be compensated. At a minimum, the tenant would be repaid 40% of the cost of the lime application. But they could argue for a bit more since the yield might have been higher for the landlord during the preceding 3 years as well. The typical cropland share lease agreement is different than those in the Corn Belt. The results shown here are from our biennial rental rate survey. The landlord typically gets a third of the crop, government payments, and other income, and shares a third of some of the variable expenses. The tenant pays seed and harvesting expenses, while the majority of respondents noted that the landlord paid a third of the pesticides, chemical applications, and line applications. A significant number noted that the tenants paid 100% of these expenses. For example, 51% said the tenant paid 2/3 of the herbicide expenses, while 46% said the tenant paid the full amount. For lime, the results were even more mixed, with 40% saying the tenant paid 2/3, 31% said the tenant paid everything, but more than 10% each said the tenant paid no lime or a third of the lime expenses. The important thing from an equity perspective is that in the final count, contributions in total align with the share of the output. Both parties can benefit from estimating their contributions. This serves as a tool for communication and a platform for negotiation. There is no one-size-fits-all. Fair doesn't equal legal. Legal isn't necessarily fair or equitable. It just is. So weighing carefully what you want in an agreement and negotiations are important. There are a plethora of reasons to put the lease agreement in writing. It serves as a memorandum of understanding. It forces you to think through terms and agree on what makes sense. It provides legal protection in the event of death or disability or some other unexpected event. If you anticipate needing or wanting a change in the lease, start discussions early. No one likes last-minute surprises when it comes to business deals. Be sure to update the agreements periodically as circumstances or the economic environment changes. When making decisions with legal repercussions, it's always a good idea to consult with a lawyer, even if it costs money. Just give a lot of thought to it before you make an appointment so that you minimize the billable hours. Because of the frequency of lease-related questions, extension specialists have collaborated in developing publications focused on developing lease agreements for cropland, pasture, livestock, building, machinery, and equipment on the Ag Lease 101 website. On that same site, you'll find sample lease agreements with downloadable, fillable forms so that you truly have no excuse to not put your agreement in writing. Reviewing it will remind you of parameters you should consider even if the other party insists on an oral agreement in the end. Economists and production specialists at OSU have collaborated in creating the aglease.info website, which includes both production and farm management information. The Budgets website has free downloadable templates to assist you in analyzing potential returns and studying what-ifs. Publications in the OSU Facts website provide rental rate survey results, highlight the tax aspects of leasing, and provide tips on negotiating. The NAS website has information on county-level rates from their biennial survey. Of course, if you'd like more information or a program on this topic in your area, please contact your local extension educator.